So let's start with estimating the cost of debt. So there are three ways. There's nothing scientific about this. I guess it's a mix of science and art. First is ask an investment banker who hopefully is well attuned to the marketplace, your company, and the cost of acquiring debt at that moment in time. And we'd ask them what would be the yield to maturity for a new bond for our company. Method two is to find a bond with a similar rating to your company, and then look at the type of terms that that particular company was able to get. What is the interest rate? And make sure it matches the debt that we have on the books. And we could then, similar to what we did in comparables, use a comparable company, but in this case, not for valuation purposes, but for determining the cost of borrowing if you were to have that same type of loan. And third is look at what you can get about the company itself, other forms of debt that are existing on the books. And thankfully, in financial statements, those are required disclosures. You will see in the notes of the financial statements detailing of the bank loans and the capital lease loans and the bond loans that are existing. And that'll give you some idea as to the cost of borrowing for the company. Method number two. I'm skipping method number one because that's a phone call and a meeting with your investment banker. We're going to look at a similar company, and this will be a bit of a review. This example is we find a company that has a similar bond rating and a similar characteristic of their borrowings. And we find that there's a company with a 15-year, 12% semi-annual bond that's selling currently trading with a yield to maturity of 1153.72. So we would say, what is the rate of interest for this comparable company? And then we can then assume, big assumption, but assume that that would be a similar rate of borrowing for us. So we can sketch this out or use the formula. I think at this point, everyone's familiar with Excel functions, so go straight to it. So equals the rate. Anytime we solve for a discount rate, we use the rate function. Number of periods, and so it's 15 years, but it's semi-annual, which means there's 2 payments per year, comma. The payments, it's 0.12 interest rate, $1,000 par, and that's semi-annual divided by 2. Next is the present value. We know that is negative 1153.72. That's the price of the bond. And the future value is the face of the bond, which in this case is 1,000. And that's what we do. So that rate is 5%. Let's put a little more accuracy to it. Your reference, we can just copy that. Is we can compute the rate of borrowing of a bond using the rate function in Excel. And the first factor is the time number of periods. And here it's 15 years times 2 payments per year, or 30. Interest payments, which are PMT, which is the coupon interest rate. It's a $1,000 bond times 12%. And that would be 120, but divided by 2 because it's semi-annual. Then look at the current price, which we have because this is a traded bond at 1153.72, and it's an outlay. So we're looking at it from the standpoint of a buyer of the bond. I pay out 1152. I get the annual coupon, and I get 1,000. That's the future value. So that's the rate of that, which is semi-annual. So the annual rate would equal that times 2. So in this case, with this bond, is 10%. All right, so back to the slides. So that should be fairly familiar, and that's one way to do it. Just look at a similar company, assume that we would have similar borrowing rates as that company, and do the yield to maturity. The next point is this whole taxation. Since interest is tax deductible, we need to get the after-tax cost of debt. In this prior example, we determined that the rate of interest was 10% times 1 minus 0.4, so the after-tax cost of debt is 6%. At this point, we're going to assume that there's no flotation cost. By flotation, we mean the cost of paying for the bond. This would be paying the investment banker, all the costs of consultants and attorneys and accountants, filing fees, any other costs necessary to do the bond offering. We'll just assume they're small for now. Also, we're assuming a nominal rate. There's no compounding. We'll simply take the semi-annual rate and multiply it times 2. That's it for simplicity. Next is, let's look at the cost if we have preferred stock. And this is a little bit tricky because Preferred stock has two components or two expectations from the shareholder standpoint. One is this fairly reliable flow of dividends to them, and the other is some appreciation opportunity. However, since preferred stock offerings are so different, we make a very simplifying assumption that we're only going to look at the yield from the preferred stock as a determinant of the value of the preferred stock and ignore this upside potential for now. The basics are it has a stated dividend rate, and you'll see that it's stated sometimes in a dollar figure like a dollar per share, or sometimes as a percentage like 10%. But 10% of what? It's not 10% of what the shareholder paid for it, it's 10% of the par value of the stock. So it's really important when you see the percentage, don't multiply it times any market-based measure, always multiply it times the par value. Very similar to bonds in that the coupon interest rate on a bond is multiplied not by a market measure, but by the face value of the bond. Same kind of idea with a preferred stock. And the other thing to notice is that it's a dividend. It's not an interest payment. And therefore, although it's the intention and it's stated and we have an expectation of getting it if we're the shareholder, it's not binding. If the company has tough times and the board of directors in their capacity as directors find that they should not prudently distribute that money to preferred shareholders, they can suspend the dividend and not pay it. And there's nothing you can do about it. It's in the provisions of the stockholder agreement that if the board in its judgment feels there should not be a dividend paid, they can suspend it. Now, the rights of the shareholders are not lost, however, because the company cannot resume payments to any of its common shareholders until it catches up, so to speak, of all the prior and unpaid preferred stock dividends. So that's just a provision in typical preferred stock agreements. There's no tax deductibility because, again, it is not interest, therefore it's not tax deductible. So we do not need the 1 minus T adjustment. It is riskier than debt because it's not a binding commitment, as we just discussed. And despite the above, many companies have a lot of incentive to pay preferred dividends. If you think about it, they offered that particular class of stock to attract investors who want the steady return of quarterly dividends. If they are seen as an issuer of that preferred stock and they don't make good on that intention, then the value of that preferred will drop and the chance of them being successful in subsequent preferred offerings drops pretty significantly. So let's look at the formula for estimating the cost. We did a variant of this in class the other day, but the return required for preferred stock equals the dividend for the preferred stock divided by the price of the stock times 1 minus flotation. And the 1 minus flotation is simply reflecting how much money the company gets. So if I get, let's say, $100 million, but I had to pay $10 million to get it, my proceeds are now 100 minus the 10, or $90 million. So whatever dividend I pay, when I look at what does it cost me, I paid that amount of money out in dividends, but my amount that I actually borrowed or got was not the 100, it's a smaller number, thereby increasing the cost of preferred stock. So that's the refinement of flotation. And we do flotation adjustments on common stock, preferred stock, and debt. This is just an illustration using preferred stock. So R sub PS is simply the return required for the preferred stock. D sub PX is dividend payable on the preferred stock. And P sub PS is the price of preferred stock. And F is flotation, as we mentioned. That's the cost of money raised. So we can try this out and look at this formula, which we just went through, and this particular example. And so we'll hop into Excel to do this. So the rate of return on preferred stock is equal to this formula and R. So it equals the dividend for preferred stock, which is 10%. So let's calculate what that means. The par is 100 times the 10%. And we divide that by the preferred stock, which is the price of the preferred stock, rather, is 116.95 times, open parens, 1 minus flotation, and in this case it's 5%, and we get a yield of 9%. And that's the return on preferred stock. And we did the annual rate dividend of 10%, and that's why this is already an annual rate, even though the payments on dividends are typically quarterly. So we took a shortcut because if we did quarterly, all we'd end up doing is multiplying that rate times 4 anyway. So that's the preferred stock returns.